Congress just reset the housing market. Getting a mortgage just became a lot easier. But how will it affect the housing market? Hey everyone! In this video, we will discuss Congress, which just passed legislation that allows people looking to get a mortgage to get up to $1 million loan with better terms than before. This new legislation could have far-reaching implications for the housing market, and we'll explore what it could mean for you as a homeowner or potential buyer. So join us as we explore Congress's decision and answer the question, how has Congress reset the housing market? We will also answer if you should start searching for houses right away. Stick around until the end to find out. The Federal Housing Finance Agency, FHFA, recently stated that the baseline conforming loan limit for Fannie Mae and Freddie Mac mortgages in 2023 will be $726,200, an increase of 12.21%, or $79,000 from 2022. For the first time, the federal government will guarantee mortgage loans in excess of $1 million through government-sponsored enterprises, with the new ceiling loan limit for one-unit residences in designated high-cost locations set at $1,089,300, or 150% of $726,200. Different loan limit computations are established by special legislation provisions for Alaska, Hawaii, Guam, and the U.S. Virgin Islands. The baseline loan limit for one-unit properties in these locations will also be $1,089,300. The FHFA's conforming loan limit increase is based on a home price calculation. In June, Fed Chair Jerome Powell told reporters that the overheated housing market in the United States, which had seen home prices jump by more than 40% in just over 2 years, required a reset. Higher mortgage rates, he added, will gradually restore balance to the market. While Powell was unsure what the Fed's housing reset would do for home prices, it was safe to say that there would be turmoil in the housing market. According to the most recent Case-Shiller data, home prices in the United States declined 0.8% in September. This is the third consecutive monthly drop in home prices since Powell's June speech. Prior to 2022, the seasonally adjusted Case-Shiller National Home Price Index had not shown a month-over-month decrease since the housing bubble burst in 2012. This newest Case-Shiller study, which reported a 2.2% drop in home prices in the United States since June, implies that the U.S. has entered the second largest post-World War II home price correction. On paper, it's tied with the 2.2% reduction between May 1990 and April 1991. However, because the index is a 3-month average, we know the October figures will be higher. However, it is still much below the 26% peak-to-trough drop that happened between 2007 and 2012. How can this 2.2% loss already be considered the second largest correction since World War II? It all comes down to the reality that, historically, national property values have been very stable. Unless economics force their action, sellers will oppose falling below market comparisons. Not only do average Joes understand that values can collapse, but the 2008 example has also made institutional investors and builders more cautious. Another reason prices may be falling so quickly is that housing prices climbed so swiftly during the outbreak. And now that mortgage rates have risen, many purchasers are either priced out or have lost their mortgage eligibility entirely. Powell also told reporters in September that the U.S. housing market had begun a tough correction. While the housing correction is undeniably here, it is far from uniform across the country. Home price declines range from negative 0.55% in Atlanta to negative 10.4% in San Francisco, among the 20 major U.S. housing markets tracked by Case-Shiller. The western half of the country, including places like Seattle, down 9.16%, and Phoenix, down 3.86%, is clearly the heart of the ongoing home price collapse. So what exactly is going on? The western half of the country, where affordability is more of a concern, is more vulnerable to interest rate shocks. Monetary tightening implies that high-powered tech job hubs are pulling back in areas like San Francisco and Seattle, precisely as tech stocks are falling. Meanwhile, rising mortgage rates sent bubbly boom towns like Phoenix over the edge. The Northeast and Midwest continue to experience a milder correction. Markets like New York and Detroit are only down 1.58% and 0.81% from their peaks, respectively. These markets were not swamped with inventory from iBuyers and builders as the housing boom ended this summer. This has provided sellers in areas such as New York and Detroit with some breathing room. It is true that we are seeing a housing correction. It's also true that the majority of homeowners are still doing well. Indeed, well may be an understatement. So yes, the 2.2% drop in prices experienced by the housing downturn between June and September has only taken a little bite out of the previous housing boom's gigantic 41.29% increase. Home prices have risen 38.33% since March 2020. Not only were homeowners protected from rent increases, but many also profited from refinancing to 2% or 3% mortgage rates during the pandemic. Zillow economists predict that the home price correction will be completed by January 2023, with a 0.8% increase in home values over the next year. Meanwhile, economists at Morgan Stanley, Goldman Sachs, and Moody's Analytics predict a 10% drop in housing prices from peak to trough, while organizations like Zonda and KPMG predict a 15% drop in U.S. home values from peak to trough. Of course, when Zillow or Moody's talk about U.S. home prices, they're referring to a national average. Whatever happens next will undoubtedly differ by market. The majority of people who wish to buy a home cannot do so in cash, especially at today's pricing. Instead, they must obtain a mortgage to finance their property purchases. If you're looking for a mortgage, you should consider a conforming loan. A conforming loan is a government-backed mortgage whose total amount is below a threshold. Conforming loans are ones that can be sold to Fannie Mae or Freddie Mac, two government-sponsored enterprises that purchase mortgages. So why should you care whether or not your mortgage is conforming? It's straightforward. Conforming loans are typically less expensive in terms of interest rates. The lenders who make these loans bear less risk because they can be sold to Fannie Mae and Freddie Mac. Non-conforming loans pose a greater risk to lenders, which is often passed on to borrowers in the form of higher mortgage rates. Meanwhile, conforming mortgage restrictions fluctuate from year to year. Conforming loan restrictions are set to rise significantly in 2023, which may benefit purchasers. Loan restrictions for conforming loans in 2023. Home prices have risen dramatically in recent years. Conforming loan restrictions are increasing to account for these expenditures. For most of the country, the conforming loan ceiling is currently $647,200. It is $970,800 in high-cost areas. The conforming loan maximum for most of the country will rise to $726,200 in 2023. It has surpassed the $1 million level in high-cost areas at $1,089,300. How big of a mortgage should you get? Higher conforming loan limits allow you to borrow more money without having to get a mortgage that is more expensive for you. However, knowing how much of a loan you can afford is still vital. To that purpose, it is prudent to adhere to the 30% guideline. In general, your housing cost should not exceed 30% of your take-home pay, including your mortgage payment, property taxes, and homeowners insurance premiums. As a result, the mortgage you take out should allow you to stay below that limit. If you go above it, you risk falling behind on your housing costs or other bills. Neither option is ideal. In fact, rising conforming loan limits should not be interpreted as an invitation to spend more on a home. These increased limits reflect the current state of the housing market. They are not intended to encourage home buyers to take out larger mortgages. Right now, home prices remain quite high, owing to a significant lack of housing inventory. Once real estate inventory increases, home prices may fall, allowing borrowers to take out smaller mortgages. However, taking out a mortgage at this time could be an expensive proposition, especially given the high borrowing rates. As a result, it may be prudent to postpone your home buying plans for the time being. In conclusion, the resetting of the housing market will have a strong impact on the affordability of housing for a long time, with conforming loan limits increasing to $1,089,300 in 2023. Borrowers should be aware of their budget and not be tempted to take out a loan that is too large for them. Taking out a loan beyond 30% of your take-home pay can lead to financial hardship in the future. So it is important to be mindful of your budget and plan accordingly. Although the current state of the housing market is uncertain and ever-changing, by taking the time to understand your finances, you can make the best decisions for you and your family. What are your thoughts on this decision by Congress? Are you in the market for a new house in the US right now? Tell me in the comments section below. Also, if you're new to this channel, I strongly encourage you to subscribe and click the like button. You can also keep up with all of my most recent videos. See you in the next one.